Good afternoon, all of you. For this QRB's webcast being organized today for the technical reviewers empaneled with the Quality Review Board. As you're aware, a lot of you have been empaneled with us for a long time. Some of you have joined only recently. So we keep on organizing these kinds of programs for a kind of a refresher program for the technical reviewers, an opportunity we get to interact also with the reviewers. Today we have CA Dayanivas Sharmaji. I welcome sir for this today's webcast. Sir is a Central Council member of the Institute of Chartered Accountants of India and is also a board member of the Quality Review Board. So he is keenly involved in the affairs of the Quality Review Board with all the functions of the board. So he is he's very well aware of what is taking place, what kind of problems are being faced, what kind of issues are being faced by the technical reviewers. Well, the chairperson QRB, Ms. Shefali Shah, she was also supposed to come here today for this program, but because of some prior commitment already, so she could not make it today. She'll be able to join us next time whenever we'll organize such type of a program. So she has wished all of you best of luck in your reviews. Some of you are already doing reviews. Some of you are finalizing your reports. And I think we are also in the process of finalizing some of the more reviews. We are going to start soon. I think in a couple of months, we're going to start some more reviews. And then all of you who have not been able to get any assignment last time, hopefully all of you will get some assignment this time. And as you're aware that after the NFRA came into being, we have been reviewing the audits of private limited companies primarily. So we'll continue with that for the time being, till the time we are able to select some more entities, some more type of entities. But we are also entering into an area of review of urban cooperative banks that we're going to start, because I think that is also not covered under NFRA. So we'll take up those reviews also. So soon, some of you, I think some of the assignments we'll select to start with, and some of you will soon get some assignments with regard to UCBs. We have taken your interest also that you have some of you already have shown your experience. You have told us that you have got the experience of doing stat audits of UCBs. So we have taken note of that, and in line with that, we will shortly assign some assignments to some of you for the UCBs. As you're aware that some time back there was some amendment in the Chartered Accountants Act, Section 28B, where a new clause was added under the functions of the Quality Review Board, enabling the board to forward non-compliances being observed during the course of the review process with regard to statutory and regulatory requirements to the disciplinary directorate of the IC. So after that, we also revised our QRB procedure that was done in December last year. After that, we revised in line with that revised procedure, we revised our reporting formats, our questionnaires, and a lot of things. And we also added a new reporting line like focus areas for review. So I'll not take much of the time. I'll request Dayanivas Sharmaji to take you through the quality review process and the focus areas for review. Sir.
Thank you, Mohit, and good evening to all the participants today. It's, I think, a little time ago, we took such kind of sessions for all our TRs. And the chairperson, Shefali Madam, has actually desired that, why not we actually think about having one session, though this time we are planning primarily to do it online. But going forward, might be we'll be doing physical also. But rightly stated, Mohit, I think 28B, which is a section which is introduced by the government and the kind of responsibility which has been reposed on QRB, is something which is very, very important. Friends, before I will take you through the presentation of the quality review process and the focus areas of review, I would like to just tell you a brief about how the ecosystem at the institute or the Chartered Accountants Act and regulations is focusing on the quality aspects of the audit profession. And particularly, remind you, for the practicing firms, it is becoming more important to comply with the fundamentals and the basics of the standards in true sense. Am I right, Mohit?
Yes.
That is what we have actually done with regards to our new checklist, which we have formed and we have given for all our members with regards to the SQC. Now, considering that factor, friends, one thing which I would like to say is let us actually visualize. Let us just visualize. It's very important to think for a moment. So many boards are there. I am fortunate. Let me just put it this way. I am fortunate that I am the board member of peer review board. I was also chairman of peer review board. I was the vice chairman of FRRB, which is I'm continuing to be the board member of FRRB. I'm a board member of TAQRB, which is again a very important aspect, and also a board member of QRB. Now, what are these boards? Above that, there is one more thing which is sitting on the other side, is called the CAQ, Center for Audit Quality, and below that, if you talk about, which is beyond QRB, is NFRA. Now, what is this all about? Let us understand very clearly. Because most of the time, people have actually got lost in the process. Why these many number of boards are there? How it is? What is the modus operandi with which they are doing? And what mechanism they are actually having their power to do certain acts and the procedures or the responsibilities that need to be discharged. Though quality review board, if you see, I'll request Mohit to put the screen on for the PPT. But though the peer review, quality review board has been come under a specific section, friends, it is a specific section, 28A of the Chartered Accountant Act, which has come into existence in 2006. Now, just think for a moment, 2006, 28A was inserted, and also in 2009, there was a peer review board which was also being initiated by the institute. Now, what is the difference? What is the ask which is there from these boards? We need to understand that very effectively. But the fact stands very simple that both boards are focusing only on the quality aspects of the practicing firms. The people who are signing the financial statements, you have to be independent. And I think Mohit left, but I'll just see that he joins back us very quickly. The point which I was trying to drive was these boards which are being formed are primarily to ensure and give focus to a statement that we, as of chartered accountants, have certain quality standards which are being maintained and we are being followed. So now, what did the peer quality review board do? Very simple. The mechanism, the people who are being appointed, that I'm just going to take you through the presentation as soon as Mohit joins. But before that, peer review board is an mechanism which we are trying to do from a point of peer to peer. Mean, before I get exposed to an external agency, whether my documentation, my filing, my office procedures, my entire ecosystem in which I am doing the financial system audit is actually been rightly captured. So my question to you all people, how many of us have read the entire SQC1? Is one question which you need to answer yourself, because today we are actually on a mono approach. One side only I am able to see and I am able to talk. But the fact is, when you talk from peer to peer, thank you, Mohit, peer to peer mechanism, it is peer review, which is before I getting exposed to an external agency, I am getting ready for the entire process. Now, once I have done a self-evaluation, first is basically I need to maintain under SQC certain procedures which are very clearly defined in the standard that this is what the firm has to do. Now, part is one, that is a self-assessment or control mechanism. On the other side, it need to be tested. Tested by whom? One peer. A peer is coming and doing that entire process. Now, once that is been done, so this was actually introduced in 2009. When you see the peer review board mechanism is actually come in 2006. The previous slide, until 2007, it was constituted by GUI. In the Amendment Act, it has actually been introduced and constituted. What is the constitution of quality review board? The quality review board is constituted by one chairperson and 10 other members. Out of that, 6 members, including the chairperson, are nominated by Government of India. And the balance 5, I'm sorry, are being, 6 are including the chairperson nominated by Government of India, who all are non-practitioners. That is the most important word. They are non-practitioners. They are not chartered accountants. They are chartered accountants or might not be chartered accountants. And other 5 is appointed by the Council of ICI. Majority of the members independent of profession and nominated by government, including MCA, C&AG, SEBI. So if you see, friends, in the current scenario, when we talk about NFRA, which is a big brother of QRB, QRB were existent. And there they also talked about a non-professional should be actually part of the board because it can see from a different perspective. So consider these 2 things as independent. Now, what is there in peer review or FRRB or QRG is primarily, they are the council members only who are being taken into the fold. Whereas, please understand, as a TR, when you are completing a review, these reviews, reports which are being given to you is coming before these external people also. Currently, we have people from C&AG, MCA, and SEBI also, right? So, considering this factor, the only difference which is there, one is it is internal, peer review process is internal. QRB, though it is forming part of a CA Act, but still it is external and it has a longer sanctity and an importance which has been given to it. So, I hope till here I am clear. Now, what does QRB do? Quality review board, there is a mechanism in which the files or the companies or the industries are being selected by the quality review board, and the balance sheet, the companies are being picked up from there, and then it goes reverse to the auditor who is signing the financial statements. Now, what is the difference? The difference is, first, in quality review board, it has been communicated clearly to the practice unit that your file so and so is picked up for quality review and so person is been appointed, where a person reaches your office, does the entire review and gives a draft report and then the final report, which is a procedural part. Whereas in case of FRRB, it is primarily neither the client knows nor the company knows that there is a review which is happening. That is a surprise review which is there. But in case of QRB, it has been well thought and the process is very clearly defined, which is having a lot of sanctity in the process. And huge amount of independence is maintained in this board, including the president and the vice president are not forming part of the board here. So please understand, this is the important part. Now, what is the function of QRB? Very simple and straight. First, to recommend quality recommendation. If you see this, 28B talks about to make recommendation to ICI Council with regards to quality of service provided by members of the institute. Mean, the moment I am doing an independent review, I am able to understand the quality at which, because the file documentation reviews, what are the assumptions, presumptions, which we are going to talk in a couple of slides later, I'm going to talk. So here it is recommendation based on my review on the quality of service which is being provided. Two, to review quality of service provided by the member of the institute, including audit services. The review of quality, what is being done. To guide members. Here it is not only to just take a punishment stick and tell you behind it. Lot of publications are being released year after year on the fact finding which has been done. Where are the major gaps? Which is the next session we are going to talk about. What gaps have been there to guide the members and to forward the cases of non-compliance with various statutory and regulatory requirements. Here I would like to stop and tell you, friends, one thing. Government expectation is very clear that the quality of audit service cannot be compromised. Simple, straight, no if, no but, no inverted comma, no full stop. One single statement that the transparency, the governance with which we are going to report has to be independent in all sense. Now, when Quality Review Board was formed, why is required NAFRA? So NAFRA has been given a specific task and QRB is continued. It is not closed. Please understand, it is continued with all those entities which is forming minus the entities which are forming part of NFRA that we are going to discuss. So to forward the non-compliances wherever the things have come. Now the listed is gone to NFRA and the non-listed is come back to QRB. What is QRB thinking about? Below the threshold limit. Why you talk about a threshold limit? Let us take a simple example on a practical aspect, which is today MSME definition for turnover is changed 250 crores. That means that person might be taking a bank loan or there might be a public interest which is included in that. So considering that factor, or might be this company is going to go upward for MSME IPO, or might be the company has become larger to go for an IPO, or might be taking a private equity, or might be taking additional loan for expansions. So the focus of the government is not to leave the smaller entities and only focus on larger entities. It is basically the entire ecosystem is to be concentrated upon, right? So here, the point which I want to drive is to forward the cases, because any major finding which is going to be there in the next presentation by Pramod Jain sir, who is a council member, on the commonly found errors in the financial statements, certain places have been glaringly wrong. Am I right, Mohit? They have been glaringly wrong, which we have seen. So it cannot be a quality of audit service cannot be based on the size of our organization. Quality of audit services is constant. It has to be same, whether it is a one single incorporated, newly incorporated company, or it is a large listed company. So the point which I am trying to drive is these matters today cannot be ignored. Please understand, it is going to take a lot of focus. Even in our recent discussion when SEBI was participating with us in the QRB, they specifically talked about those entities which are not coming under the ambit of NFRA and getting excused for not being in the threshold limit, but they are associated joint ventures or might be subsidiaries. In that case, at least focus on those entities as well. Now, about the functioning, again, furthermore thing, when you talk about this MCA clarified QRB, that in view of NAFRA rules 2018, the issue of QRB reviewing audits of companies or bodies corporate specified under Rule 3 of NAFRA will only arise in case of references so made to both by QRB to NAFRA. And also, the most important part is they have kept, as I told, NAFRA entity out of it, and the non-NAFRA entities is still lying with the QRB only. And let me remind you one thing. Earlier, when the listed entities were there, the volume was less. Post listed entity moving to NFRA, the volume in QRB is increased. And the expectation from all of you is very high in QRB matter. So we request you to kindly ensure that you don't take a lighter stand, because we are not going to do a justice if a light stand is being taken, as it is a private limited company. A reporting framework which has been defined by the Act, law, regulation, standards has to be complied with without a second thought. Without a second thought. If it is a balance sheet and profit and loss account, which is of only 1 lakh rupees, still you cannot get away from Schedule 3. It is required under the Companies Act that you need to do it. So these are some things which we need to really keep in mind. And this is the next slide if you talk about the methodology. Now, what does the methodology say? Procedure of quality review. QRB issued procedure for quality review of audit services of firms, laying down necessary system and methodology in this particular aspect. Now, my question to all of you, before you go for a review under QRB, have we all read, point number one, implemented the SQC1 in your own firm? Let us talk honest. And if you have read and the implementation is done, then the eligibility of going and doing it right can actually be thought about. In 2022 December, I still remember Mohit and I were discussing on a continuous basis with regards to the framework which we wanted to give with regards to the new questionnaire which has been developed, which included the SQC1 compliances also. Now, one side you are talking about a standard which is the mother of all standard, auditing standard, which is SQC1. Second side is all the standards which are auditing standards have to be aligned, and the entire file documentation procedures that need to be followed is to be followed in true spirit, friends. Please take it from me. You are, working with any of our firms has to, because the expectation is of the nation. It is not the expectation of an individual we are talking about. Time and again, even if one case is reported against a chartered accountant, it comes on a front page. We are not here to punish people. In QRB, only a major mistake is only been reported to disciplinary, but otherwise, most of the time, we are actually giving advisories. And the publication which is coming out from QRB, I think each one of us have to really understand the gaps which are being seen. If it is in a gap between in the firm, the same can be there in my firm. Let us give that entire report or the book which is published to our own team members to ensure that the compliance is effectively done. Involves review of work of statutory auditors while carrying out their audit function so that QRB is able to assess quality of audit and reporting by statutory auditors. If you go back and see, most of the cases which NFRA has reported is primarily on this aspect, quality of audit and reporting by statutory auditors. And the next part is quality control framework adopted by them in the conducting of audit. Now, what is quality control framework? SQC1. In SQC1 is fine. But there is a requirement that there should be a review of a person who is signing the financial statement. One more person from the firm should look into. Or alternatively, we can think about having an external person to look into my financial statement which I have signed or the working papers which I have built up. And that is called the external reviewer, EQCR. If that framework is not there, who is assessing us? Then the thing which comes is the peer review board. The peer review board has to look into all the compliances, whether it is done, and then hand over the report. But unfortunately, most of the people are just trying to skip that process and just getting exposed to the QRB in a front end basis. So my request to you all people is quality control framework is something which is now going to be very, very seriously taken up And I request you all people to ensure, sir, it's very simple. Peer to peer is one concept, or a self assessment process is second process. Before I get exposed to any third party agency, it is worth I actually follow all this guidance which are being issued by the institute in true sense. So please understand, quality review board. The word itself is very simple. Quality review board. We are going to review the quality of the firms in a true sense. The files which they have signed in true sense. There is a mechanism of selection of industry. Mohit, I don't know whether I can share this with regards to when we talked about the selection of industry during the COVID time. Can we do? You are muted.
So broad principles are always included in our report,
Yeah,
annual
so
report.
broad, yeah. So if you can just put that thought, Mohit, to that extent, whichever extent you think it is legally right, if you can just say, how did we do the selection of those entities which were impacted in our COVID time?
Yes, sir. At that time, I think there was a report analysis by the Reserve Bank of India committee, which had analyzed in detail about what kind of industries were impacted by the COVID-19 impact, and those industries were exposed, mostly exposed to the risk of that, which was being felt at that time. So we had basically identified companies arising out of those industries, and so to pick up cases on high risk cases were picked up on, because we follow a risk based approach in selection of audits for quality review. So that approach was followed properly in that year as well.
Yeah. So, friends, you heard Mohit also, right? There is a mechanism which we follow. Automatically, what happens when you start following a mechanism? There is a we internally first QRB is aware that these are the riskier segments which we need to look into. Example, a hotel segment, or might be X, Y, or Z, whichever you want to take, and the industry has been picked up. That means that evaluation of the seriousness of an audit is already being taken at a QRB level. So that means, what is the role you need to play? You think over. The file which is coming to you for review is not a simple one. It is one of the most important one, because there is a thought which is already gone, and then it is presented in the board, and that concept is applied after approval is applied, and there is an evaluation of that entire process which has been done. Now, what is the approach which we follow? Review all aspects of how an audit was performed in entities selected in a transparent manner in terms of the procedure issued by QR. This is what I shared. This is a real time thing which we are trying to put it before you. Why did we say this to you all people is, please understand, there is a scientific approach of selection of entities. Avoid conflict of interest of all person involved in the review exercise. I need not tell, the moment you talk about conflict of interest, all of us have to move 10 steps back and say it is at the arm's length. Otherwise, I am interested. Maintain confidentiality of information obtained. Obviously, when you go as a TR, the first thing which you need to do is you need to maintain the confidentiality in true sense, because you are giving a declaration. And this is the way a sanctity of the profession is actually being looked in from a total approach manner. So the next slide is primarily about the outcome which is being taken up. If there is any major deviation, then only the cases are forwarded to disciplinary directorate. Otherwise, we are issuing advisories. So don't think that the efforts which you are putting in is just getting into a file as if you are qualified one report and that is going to get filed in a website somewhere. No. Here, the moment you report something, there is a thorough report analysis of that entire thing done, because it is challenge which is there with regards to the disciplinary mechanism which is there, and you know the outcome of it. Published summary of observation, which I was talking about. I think every firm in the country should have this summary report, which is published year on year. And I request you all people, when you are actually talking to anyone, when you are, because you are very few soldiers in the entire ecosystem of QRB, very few soldiers, but you all are so important that you can become a protection wall. Am I right, Mohit? If these people, the way their experience they are going to put forward before the firm in advanced level, go and take sessions in the branches where you can actually go and tell that these are the kind of, don't have to refer the cases, but whatever has been published, you can take that and actually put forward before the members, and keep them vigilant to that level, right? Now, the next is on the scope of review. Forward cases and all is this has all been covered. Forward, there's a scope of quality review. If you ask me, there are 7 points in this. If you read from my eyes, it is basically auditors working papers for selected files to assess quality of their work. Quality of their work is 1, to assess quality of their work. 2 is to ensure that the financial statements are free of material misstatement. This is the second point which we need to keep it in mind. 3, internal quality control placed in the firm. What do you have in the firm, whether you are in compliance with SQC1 or not? This is the third point. The fourth, whether the firms are independent in their entire approach. 5, compliance with technical standards, which is the most important part. And technical standards doesn't only mean accounting standard. Please understand, it is auditing standard, ethical standard, any other document which has been released by the Institute of Chartered Accountants of India or MCA, including the guidance notes which are being given, technical guides which are being given, that need to have a reference in the entire process. And the 6th is the site inspection and interview with professional staff, which is one of the most important process, and discussion of finding. So the scope of review is to do all these activities in a true sense. Please understand. There cannot be any option apart from this. You do the entire assessment in totality, you will be left with only the 7 steps if you understand thoroughly and effectively. Let us go to the next slide, which is quality review process stages, which you all have actually gone through. I can take you through the entire thing again, but that is one of the most important aspects which we need to look at. One is the QRB selects the audit firm, undoubtedly. The technical reviewers are also being picked up based on their experience and the location, both sides. Technical reviewers to convey his acceptance of by LOE, then intimation to the audit firm, then it goes to technical reviewers. Quality review program questionnaire is being sent to the audit firm, which they need to fill up in advance. Carry out the quality review by visiting the office, right? Then preliminary report has been issued to the audit firm. The audit firm in turn has to give their response. Then the final report is being sent to the QRB. The QRB reviews the entire mechanism, and then it goes to the entire process where the quality review group is considering, because there is a specific group. In case of FRRG or PRB, there are internal people like council members, but and some external people also. But in case of QRB, it is only the internal member group which is there, which is reviewing the technical report or technical reviewers report in the entire group. And the quality review board consider the recommendation of the quality group and decide what is the fate of the entire situation. Right? Mohit, I hope all the points are covered in this. Oh my God. Again, he's dropped off. Any questions here you have? I don't know. How do I connect? Now, before Mohit joins, let us just wait for a moment. He'll be joining anytime. Yeah, Mohit. Now, on the slide number 11, when we talk about specified format of final report, is very clearly what is happening, friends, is basically, let me just share with you all people the challenge which we are facing at the quality review board is that the formats, though it is given, Mohit, you can actually share full screen. वो नीचे का बटन जो है ना स्लाइड का स्लाइडर बॉटम हाँ yeah. So when you see from that perspective, here the challenge is all these formats are given, but most of the time the reviewers are missing out on some or the other thing. So let me, however, take you all through the slides. Next slide, Mohit. Appendix 1 is to give the details of observation raised by TRs. Very clear, very crisp. What is required is been put before you all people in the right format. Appendix 2 to give general information about the review. Right? See, one thing which I would request everyone is when you talk about a general information about the review, let us be little serious on that particular aspect, because on the other side of the table, when we all are sitting, we find it difficult to catch this language. So just try to put a summarized version of what you have done in the review and what is the client, file which you have picked up or the firm you are talking about in a specific manner. Might be we'll share with you what is expected kind of report which we are looking at. Mohit, can we do sometime? Might be we can share it with people what is required. A general, वो जो standard document होता है.
Yes.
Right? Then the next slide is about the information, the questionnaire to include what all. This is something very, very critical. Now, one, standard on quality control, questionnaire is there. Two is standard on auditing, standards on auditing. There is a checklist, or might be prepare some document which is there, which you can actually have, or might be share it with the people so that they can update the information. Accounting standard or indexed applicability and the checklist which is there. Caro ka report, and then Schedule 3 of Companies Act. Generally, the people are missing out on Caro, thinking that it can be a general statement. But these are all the statement of facts which we need to mention as an auditor. And please guide our members at a larger level if there is any miss out which has been done, to do it in a true sense. Appendix 3 is about, it include all detailed questionnaires on this aspect. Right? Mohit, can this information be shared via mail to all the firms across the length and breadth of the country? Is it possible to share it in advance?
Yes.
So we will think about sharing this kind of information in advance, and then because at least people will get to know what they're going to get assessed, because now our criteria has also changed and almost all the firms are going to get covered in this entire process, right?
Yes.
So now the appendix, the next one is appendix 4 and 5. It gives the details about overview and information on planning and performing the review. It includes 5 is brief about profile of the technical reviewer and the assistant. So these are some things which are very clearly given to all the TRs, and we are expecting that this data is filled up in a proper and a complete format. Though there are a couple of people who are doing it very meticulously, which we appreciate, but some of them are actually missing out somewhere. So please, we request you to kindly ensure that the the review of this entire 5 appendix which is there is being completely reviewed before sending it to the QRB, right? Now let us go to the summary of final report. Observations raised by TR, technical requirements, firm's final reply which has been received, TR's final comment, and classification of materiality. One thing which we have seen in the process is either the TR is not responding, or in case of a firm, the firm is not responding. Wherever you find it difficult, where you can reach out to us, kindly let us know, which we would like to help you out. We'll surely help you out. And the summary is divided in three parts. This is something which is very, very important, which is actually being wrongly understood in certain cases. And honestly, Mohit, if I'm not wrong, and if wherever you want to add after my statement is completed, please, friends, this is something which we need to really understand well. What is a matter of non-compliance as defined in the procedure of quality reviewer, other matters of improvement, and general matters of general interest? This categorization is not coming to us effectively. They are mixing it. They are trying to do it. And if there is any question with regards to this, you can surely ask us question. We'll love to guide you. But this 3 report, because it is going to define the fate of the firm which you are doing. It is going to define the fate of the firm. Please understand. And in case you require any clarification on this regard, Mohit is always available on a call away. So what is happening is the final report, when it is coming to us, it is a document which has come to us by means of either mail or might be post. And this is a final document. So please ensure what is to be reported in these categories should be reported. I'll request Mohit, if you have any points to mention on this, kindly guide.
Yes, sir. As per the procedure, sir, when the procedure was last revised in December 2022, after the amendment of the Chartered Accountants Act, what was required from QRB was that the non-compliances would be required to be forwarded to the disciplinary directorate. So what we have done is that we have defined the term non-compliance. What would be the non-compliance in a procedure? So para 2L of a procedure defines what is a non-compliance. So that clearly defines what exactly is, when exactly they would be calling it as non-compliance. Primarily, it is when the item being reported as materially affecting the truth and fairness of the financial statements in terms of non-compliance of certain technical standards or other guidance note or other relevant guidance which are required to be complied with by the audit firm. If it affects materially the truth and fairness of the financial statements, then primarily it is clearly defined in the procedure. One can follow the entire things. So it has 3, 4, 5 subcategories where it could fall under as a non-compliance. So primarily the purpose is that it should materially affect the truth and fairness of the financial statements. Only then it would be called as a non-compliance. And then such cases are required to be reported separately with all the facts and figures, clearly describing that the item is material, clearly describing the materiality thresholds, clearly describing what is the basis of terming it as a material item, why you are calling it as material. So clearly describing everything, it would help the board in taking a decision whether it would be required to be sent to the disciplinary directorate, or if it is not considered as a non-compliance, if the amount is not material, if item is not considered as material, then it would constitute as a matter for improvement and would fall under the other second category, other matters for improvement. So such cases would be required to be sent to the audit firm with an advisory. So where we will advise the firm to comply with these requirements in future. In case of a consistent non-compliance by the firm on such matters, then we can take a call and send it to the disciplinary as this firm is continuously not being able to comply with such matter. But if it is a matter for improvement, if it is not materially affecting the truth and fairness of the financial statements, it would be categorized under other matters for improvement. So this categorization under these 3 categories would certainly help us in a lot better way while considering the reports of the technical reviewers at the level of the group. So we are also joined by our other speaker, CA Pramod Jainji. I welcome him for joining at the webcast.
Namaste ji.
Welcome.
Namaste. Thank you.
Namaskar, Pramod bhai.
Namaste Vidya.
So, so what we can do, Mohit, is basically with regards to this particular compliance, let us just send them again, as because today is a discussion happening, that particular provision which is describing non-compliance very clearly. And I hope all people have understood the clarity with which Mohit has spoken. In case you have any query, kindly reach out to us because it is becoming a little difficult task for us. And in certain matter, if I cannot word it out, but the fact is that these kind of observations are being told to be reported directly to DC. So the challenge is going to be the firms which are, if you are not able to define that in a true sense, the implications are larger. Please understand. So be very clear in that entire thought process. And if you think that there is a difficulty which is being faced, reach out to the secretariat of our QRB. Mohit will be there to help you out. Now, let me just quickly tell you the next part. Common problem areas to a greater extent we have covered. We'll be sharing this, details because Pramodji also has joined and I have to take my flight. So let me just quickly take you through the next slides, which is on the focus areas of review. I'll just put very clearly the top line because the internal matter you can comfortably understand. Auditors' independence is been questions across the length and breadth. So my request is basically when you are doing the QRB review, the most important test which you need to go through is the auditor's independence and the firm's independence with regards to the client is to be touched upon very closely. Now, next is quality control systems and supervision, which is primarily very clearly described in your, SQC1. And if you think that you are finding it difficult, these firms might have already gone through a peer review process. They might have completed the entire thing. So kindly check their report whether there was any kind of non-compliance which have been reported in peer review board process, or might be ensure that the governance and the internal quality system of the firm is very clearly defined. Fortunately, ICI has come out with a new practice management software which covers all the aspects of SQC1. Let's encourage our firms to, it's a free of cost tool which is available, right? Then you go to the next most important slide, which is professional skepticism, which is, there is no second thought about the professional skepticism which we need to follow in the entire ecosystem, right? You cannot just be comfortable because, and why did the rotation come? Why there is a change in auditor? Why is that, the statutory auditors are being told to look into certain other aspects? Please understand, these aspects are to be, missing. Auditors have appropriate and sufficient audit evidence to demonstrate that the next slide is on the audit evidence. And next slide, Mohit. So when you talk about audit evidence, let me just put forward before you have been on the disciplinary bench also, friends. The fact is, the files which are being reviewed by all of you, ensure that the audit evidences are available in their file. See, warning them at this stage is much better. There might not be a non-compliance of an entity. Understand, Mohit, कभी जरूरत नहीं है कि उसमें fraud हो या कुछ बड़ा problem हो. But audit evidence also is to be verified by you people, whether there is a right set of file which has been developed. And in this particular case, there might not be a problem, but in other time to come, just put them on tight situation where the audit evidences are to be documented in the file. The next one is understand the entity and its environment. Today, the biggest challenge is understanding the entity's environment and its operation because it is directly going to impact your going concern. If I don't understand the entity and its environment, the risk in which the organization is operating, you see what has happened in COVID. Companies have been washed off. So the technical thing is whether the auditor is looking into these aspects or not. Kindly check and ensure that in other files, at least they are maintaining this entire, documentation with regards to the understanding of entities and its environment. And then related party transaction. Next slide is on the related party transaction. Friends, the biggest challenge which we are finding is, which most of the regulators are coming back to ICI or might be QRB, or what we are finding is the related party transactions have been taken very light. Please ensure that you people you ensure that the verification is thoroughly done with regards to any related party transaction which is reported. Point number one, if it is reported. Number two, what is the basis of reporting in the related party transaction? Do they have a right section? Number three, what is the mechanism which has been followed by the firm to ensure that there is no related party which is missed out? So these all aspects have to be documented well in the file of a practice unit. That is the most important part. Then the next slide is also of related party only. But let me just, and yes, whether the company has a RTP policy or not. So this covers all the three aspects which I was talking about. Then auditor's responsibility relating to fraud. This is something which is very, very critical now. Very critical. And under PMLA also now, that is a requirement which has come. That is a separate discussion which I would like to say. But whether any whistleblower mechanism is there, whether any other aspects which is there by company, by employee, or by promoter, whichever it is, we need to actually have a right reporting structure. Whether the auditor has assessed possible risk of fraud by focusing on. Forget anything if the last 3 points, if you see, and today you are talking about audit trail. Audit trail is nothing but to justify all these 3 points. The auditor's requirement to test journal entries, the assessment, kab pass hua, chutti ke din pass hua, a holiday, which time we have passed an accounting entry. Every aspect today in audit trail has been focused upon, and that need to be documented by the auditor that this is the mechanism in which we have tested certain things, and that should be forming part of his working paper. Then only you are able to give the response to this situation. Then the next one is with regards to accounting estimates. Areas which is requiring accounting estimates are few, but they are critical. So please understand, I'll tell you about a recent client discussion which I was having on a particular industry. The previous management was thinking about the depreciation of that particular asset can be only for up to 25 years. And based on that, the criteria changes. But whereas the new management which has taken over the company says that the life of the asset is 35 years and my reporting requirement is going to change and my depreciation mechanism is going to be different. Similar is the case with your employee benefits, which you are going to talk about. Similar might be the case with any kind of assumptions which are being used for determining the provisional entries. The effectiveness of that also are to be looked into. The accounting estimates are something which need to be focused, documented well, and it has to be tested every year, time and again. So that is another thing which I am talking about. Again, use of experts. The next slide is on the use of experts and the expectation. Undoubtedly today, when you see from the institute perspective, MDPs come for what? The valuation of plant and machinery which is there is to be certified by an engineer, not a chartered accountant, or might be a cost accountant or any other person. So we need to ensure that wherever an actuary, employee cost benefits are to be valued by an actuary, but it is not that you take that certificate and put it in the file. The assumptions which are being used by an actuary need to be vetted by you. Then only you can certify that numbers. So that is also one of the most important part with regards to use of experts in totality. Then materiality and audit sampling. What do I say? When we were discussing with one of the regulators, Mohit, it is very important to say that the sampling technique, why do you require in the era of technology? They are talking about a situation there should not be sampling, and I want not limited assurance, a full assurance in the entire financial statements. Now just imagine expectation of a regulator is ahead of us. Please understand. They are telling transactions which are getting recorded effectively, GST payments, income tax payment, TDS deductions, this, that, everything is done technologically. When all the transactions are being captured, very few are left out, which you can otherwise verify and say, and it cannot be true and fair. It should be true and correct. That is the expectation which is going of a regulator. If that is the expectation which is going for a regulator, then what is the kind of mechanism which you should be If you are a reviewer of a reviewer, you are doing audit, you are the auditor of auditor. You are auditor of auditor. So what kind of advancement you should be having as a TR? Just think about it. And the last slide, which is there, which is a root cause analysis. TRs have to focus on development and implementation of root cause analysis process, which is one of the most important parts. See, in this entire process of quality review, let us not restrict to only find out mistakes and errors. Let us see if we are able to handhold each one of us and see that there is a knowledge sharing which has happened among us so that effectively the knowledge can be disseminated. Right? I'll be back again with you guys very soon. Thank you very much for giving me this opportunity by the QRB and the madam as such, the chairperson. I tried my level best to ensure what are the focus areas which we need to look at, what is the expectation of the regulators, what is the expectation of the government, and the most important part is on the quality review process point we have discussed at length. Friends, let us ensure that the quality review process is an effective mechanism where we are adding value to the people and also the people who are doing something intentionally wrong, and we don't spare anyone. Let us take a determination. We are getting into the 75th year of the profession, and CA Act is come before the Constitution of India. And that is a time when they thought about this profession is going to take care and be the soldiers of the financial ecosystem. And we have to actually demonstrate what the best we can do from our side. I wish you a great learning experience. Any questions specific which are there, Mohit, I'll request you to kindly take it up. And we can, I'll have to move because I have to just rush for the airport. Thank you all. Thank you very much. Namaskar, Pramod Bhai. Thank you very much for being there.
Thank you, sir. Thank you so much, sir, for enlightening all our reviewers with your experience as a council member, as a board member of the Quality Review Board, and what are the expectations from our reviewers you have been able to share with the reviewers so candidly. I think they must have been benefited a lot today with your views. Thank you, sir. Thank you for joining us.
Thank you very much.
So, friends, we are now joined by CA Pramod Jainji, who is also a board member of the Quality Review Board, Central Council member of the Institute of Chartered Accountants of India, and has also been a reviewer with the Quality Review Board in the past also. So he's having all the in all particular manner he has served the Quality Review Board as a council member, as a board member, as a reviewer also. So he'll be able to share with you his experience in all these manners today with us as the role and responsibility of a technical reviewer. I think none other than no person can be better than him to explain about the role and responsibility of a technical reviewer with regard to the technical standards, compliance of technical standards. Sir, over to you, sir. I think you are muted, sir.
Sorry. I was at that time muted, so I did not unmute myself. Thank you, Seymour Begalji. At the outset, my congratulations and thanks for organizing such a meeting online for all the technical reviewers. I also thank our past speakers, Dena Sharmaji, our Central Council member and the member of the Quality Review Board, who shared his views and experience regarding the procedure of the quality review. In fact, it is really very, very righteous of Mohitji to have thought about and organize this orientation or a meeting with the technical reviewers. You all have empanelled yourself as a technical reviewer. You're all doing audits. So you know that when an audit is to be done, then we have to ensure that the proper audit of the technical standards and the financial statements, they all have to be properly taken care of. Just I can share a few things that I don't know whether all of you at your own level have got your forms peer reviewed or not. I'll request all of you to get your forms peer reviewed, your form, which, and specifically, if you can see that the audit which you have done and which you have represented to the quality review board, that based upon this criteria, you have empaneled yourself as a technical reviewer, so that when your firm is peer reviewed, that the quality of the quality review is enhanced. We're in the process of making that also as a criteria for a technical reviewer to be empaneled with the quality review board. The intention, as already discussed by Dena Shimaji, is to ensure that the quality of the audit is not only maintained but improved on a regular basis. We all know the process which was discussed in the last session, that how an engagement or a firm is picked up, and then how the technical review is to be done and what has to be taken care of. So I'll be sharing a small presentation and then discussing about that. Is my screen visible, Mohitji?
Yes, sir.
Thank you. The role and responsibilities of the technical reviewers and the compliance of the technical standards. You know, the content of this presentation would be, of course, the scope of the QRB, key statistics of the reviews done by the QRB, the key statistics, the scope and objectives of the reviews, then the types of observation. We'll be discussing upon various types of observations in the materiality and certain key findings for the financial year 21-22. And in relation to that, basically on the three issues. One is the standards on auditing, second is the accounting standards, and third is my Schedule 3 CARO and other regulations. So in all, we'll be discussing about this, and we'll be sharing that what were certain points which certain technical reviewers has noted in their reviews and brought that to their final report, and they were taken by the QRG and then to the board. But before that, we all know, which must have been discussed in the earlier presentation also, that this QRB is established as per the section 28B of the Chartered Accountants Act 1949. And it has got 4 activities to perform. That is to make recommendation to the council of the ICI, with regard to the quality of services performed by the members. B, to review the quality of services provided for the members of the institute, including the audit services. Third, to guide the members of the institute to improve the quality of services and adherence to various statutory and other regulatory requirements. This D, this was added by the Chartered Accountants Act 1949 and has become very, very important. Earlier, what used to happen is that if there was any matter which the institute had to send to the institute, the quality review board had to send to the institute, it has to send to the council. But through the process, it was sent to the discipline directorate. But now, under the Chartered Accountants Act 1949 itself, the functions which the QRB has to perform, they have added to forward cases of non-compliance with various statutory and regulatory requirements by the members of the Institute of Firms or firms, noticed by it during the course of its reviews to the disciplinary directorate for its examination. So now it has been enabled directly into the Chartered Accountants Act 1949 that QRB will have to forward the cases of non-compliance with various statutory and regulatory requirements. Now, here my request to all the members, technical reviewers out here, that when you are reviewing, you have to be very careful in understanding that what are the cases of the non-compliances. What are the cases of the non-compliances? Because if I talk about when you finalize your report, there is a preliminary report, then you get the response, then you give your final report. So do you feel that it is has material that a disciplinary action should be taken against this? So you have to be very, very careful while finalizing your report. It is not that when you are a technical reviewer and you have to issue a report, everything is material, everything is a non-compliance. So what is a non-compliance? That in the procedure of the QRB that has been amended, which is coming in the further slides. So while framing your reports, what is material, what is non-material, what is the non-compliance thereof, one has to be very, very careful. And here we request all the technical reviewers to be very, very careful about this. QRB is there since 2000, I suppose, 12, and thereafter it started the reviews in 14, 15. It is there since 2008, and then 12 it started the reviews. Our post-constitution of the NAFRA, MCA had clarified that in view of the amendment to section 133(2), read with the rule 9 of the NAFRA rules 2018, the issue of QRB reviewing audits of the companies or bodies which are kind of covered under NAFRA, that is rule 3 of the NAFRA rules, that will only arise in case a reference is so made by the NAFRA to the QRB and not otherwise. So those listed entities, those entities with a turnover 1,000 crores and above, so that the criteria which is given in the NAFRA rules, that those companies which are covered by NAFRA, the NAFRA would be reviewing, and other companies, the QRT review board would be reviewing. Accordingly, now the QRB can initiate reviews of the quality of services provided of the following category. So you might be thinking, all those who are reviewers, technical reviewers of the old, in the era when there was no NAFRA, that earlier the reviews were coming of the listed companies, the auditors of the listed companies, but now they are not coming. And this is, I would say, a huge change, because now what the NAFRA is, because the NAFRA is conducting reviews of the unlisted public companies having paid up capital less than 500 crores, or having annual turnover less than 1,000 crores. So above these, NAFRA is conducting; below this, the QRB reviewing it. Or entities which are having in aggregate outstanding loan and debentures and deposit less than 500 crores as on 31st March of the immediately preceding financial year. So not only the private companies and other entities not specified under Rule 3.1 of the NAFRA rules, such as non-corporate entities, trusts, cooperative societies, NGOs, LLPs, they all are now, QRB has a power to review all these entities, the audit of these entities. And companies or body corporates which the NAFRA refers to us. So QRB has also issued a revised procedure which is hosted on the QRB website, that is QRBCA.in. So you can refer that. Now, what has been observed after the coming of NAFRA, when this changes have been made in the procedure, where the QRB is not being the listed entities, but the unlisted public companies and even the private companies, where the annual turnover is less than 1,000 crores, or paid up capital less than 500 crores, or deposit less than 500 crores, that the auditors may be of the bigger firms, maybe Big 10, Big 4, what we say, Big 20, or other than Big 4, Big 10, Big 20. when the audit of these unlisted entities or entities which are not covered in NAFRA, that is done by even that big entities, big CA firms, or the small and medium CA firms, the quality needs to be improved of the compliance of the technical standards, whether it is accounting standards or standards on auditing, because we see that in case of these entities, the emphasis on the documentation, the emphasis on the accounting standard needs a drastic improvement. So, which has been observed, in the past few years after coming of the NAFRA. So, when you are doing the technical review of such entities, you have to be very careful in ensuring that even in these smaller entities or entities not covered under NAFRA, the compliance of the SQC, the standards on auditing, accounting standards, they all are done appropriately, right? So since financial year 12-13 to 22-23, the QRB has completed 623 reviews, which is a huge number. And out of this, 36 cases have been referred to the ICI Council or the Disciplinary Directorate for the further action, taking the disciplinary action against them. 36 cases, which comes to nearly more than, I would say, 5%. 386 cases, advisories have been issued by the Quality Review Board to the concerned audit firms for the improvement in audit. And 201 cases, they were closed as they were found to be generally acceptable. Now, in case of now a non-compliance, the QRB will be sending it to the Disciplinary Directorate, but please take care, even in the case of advisories, when you go to the CAG empanelment, in the ranking, in the points which they are, there is a deduction of 10%. There is a deduction of 10% thereof. So advisories are, as I would say, having a huge impact when the advisory is issued by the QRB. So your role as a technical reviewer becomes very, very important in ensuring that the review which you do are qualitative and proper. When you give your reports, the QRG, the quality review group, is able to determine that in which cases there could be a non-compliance resulting into sending it to the disciplinary directorate, and which comments should be taken care of while issuing the advisories, and which are okay when they say generally acceptable, and just they at the time of review itself, they agreed that they would be taking care of that and improving their audit quality. The main purpose is to improve the audit quality only. If we see the overall trend for the past, I would say, 10 years, the audit engagements, if we see 6% of them, of the overall, said that there are significant improvements required. And in 62%, it was that improvement are required, but may not be significant, but improvements are required. And 32%, they were generally acceptable, the audits were done. So again, 62% is also a huge number. 62% of the total reviews where the board felt that improvements is still required. Not only board, you all, the technical reviewer, you also felt that yes, the reviews which we have done, the audit which has been done, the auditor needs to improve their reporting quality or the documentation accordingly. So let us go into the role and responsibility of the technical reviewers, the compliance of the technical standards, and the scope and objective of the review is that whether the statutory auditor has ensured the compliance with the applicable technical standards in India and other applicable professional ethical standards and other relevant guidance. And here technical guidance are, I would say, the accounting standards, the standard on auditing, the SQC, the other guidance notes and other materials issued by the ICI, and relevant laws, Schedule 3, relevant applicable statutory requirements. They all are other requirement, but yet technical standards are these standards. Whether the statutory auditor has ensured compliance with the relevant laws and regulations as required under the applicable auditing standard, whether the audit firm under review has implemented a system of quality control with reference to the applicable quality control standards. This quality control standards, the SQC1 is one of the most important standard. And if we see the whole questionnaire which the QRB, the technical reviewer sends to the audit firm, or the peer review board sends, or the NAFRA sends, everything is based upon the quality control, the standards on quality control, SQC1. So you should emphasize and go through that very, very carefully. Whether there is no material misstatement of assets and liabilities as of the reporting date in respect of the selected entity. So that is a scope and objectives of the reviews. So types of observation, again, into three. One is non-compliance, second is other methods of improvement, and third is matter of general guidance. Now, again, as discussed in the previous slides, this non-compliance is a very, very important aspect. And therefore, in the procedure for the quality review of the audit services of the audit firms, this non-compliance have been defined and which should be understood, which was even talked about by Dayanivasji in his previous deliberation. Here it says that non-compliance, that it means situations where financial statements are not materially prepared in accordance with the requirements of the applicable financial reporting framework, considering the qualitative aspects of the entity's accounting practices as would affect the truth and fairness of the financial statements, and the auditor has not reported accordingly as per the applicable standards on auditing. So the financial statements are not materially prepared. It is the responsibility of the management that they are not materially prepared so as to reflect the true and fair view of the financial statements. So when the financial statements are not disclosing the true and fair view, what has the auditor done? Whether he has reported accordingly as per the SS700 series, 705, 706, 71, so all those, whatever is applicable, according to that has been done or not, right? Or, so that is a non-compliance, so it will go to the DC. Or, auditor has not obtained a reasonable assurance about whether the financial statement as a whole are free from material misstatements, whether due to fraud or error. Or, auditor does not express a modified opinion when, having obtained a sufficient or appropriate audit evidence, concludes that misstatements individually or in aggregate are material. Or, in other cases of non-compliances of technical standards or other relevant guidance or other relevant laws and regulations as would materially affect the truth and fairness of the financial statements. When the QRB receives the report, so we have seen that when the technical reviews report, they say everything is material. Everything, you have to see that materiality concept which is defined under the standards of auditing. Is that material? Is that affecting the truth and fairness of the financial statements? Because, even the non-compliance of technical standards, now suppose there is a non-compliance of technical standard that we say that in the case of cash and cash equivalents in the cash flow statement, instead of cash and cash equivalents, the entity has written cash and cash balances. So cash and cash balances, when it is written instead of cash and cash equivalent, if I say technically, yes, it is a non-compliance of the Schedule 3 of the accounting standard, my AS3 or my IND-AS, where it has to be cash and cash equivalent. But is that materially affecting the truth and fairness of the financial statements? Merely it should be worded like this, but it has been worded like that. Is that materially affecting the truth and fairness of the financial statement? That cannot be material. That cannot be a non-compliance to invite the disciplinary directorate out there. Yes, areas of improving that the auditor should say. Now let us take another case in this case itself. Now instead of mentioning cash and cash equivalent, it is written cash and cash balances. What should auditor do? Is the auditor required to qualify his audit report for the same, or make it as an other matter? It cannot be emphasis of matter, but can it be another matter? So where would the auditor put that? So if that non-compliance is there, was the auditor required to put that into the auditor's report? So in that case, we have to look again into SA 705, 706. Either what is given under 143.1 or 143.3, or my CARO report, or companies, auditors and auditors rules, rule 11. What are the points to be reported? Is any of these could be covered into my reporting SA 705, 706, or the points which I said? And if that is not provided, then of course it is a non-compliance on the part of the auditors. That we all technical reviewers should very, very clearly understand. Right. And then, of course, the other matters of improvement, that is the improvement in terms of strengthening of the policies and certain aspects related to planning, risk assessment, documentation, and certain disclosure requirement in relation to financial statements. These are all areas of improvement. But again, when you are making it as a non-compliance, then it has to be within this paragraph definition, which is there in the quality review audit services. Now, again, I'm saying this non-compliance will result into discipline directorate, referring it to the discipline directorate. But even if there are certain aspects of the audit which may not result into affecting the true and fair view of the financial statements, but still there could be something where there are areas of improvements and you feel that the advisories should be given. Of course, that would be the call has to be taken by the quality review board. But then those areas you have to again mention in your report. Of course, the format you all are having it. Because again, as I said earlier, even those advisories are having an impact, and huge impact, which earlier was not happening. I'm again telling you, it was not happening. It is from the last year when these advisories are also having an impact, right? And of course, the matter of general guidance of the audit firm and members that we have been discussing. So what is in materiality? Accounting standards are intended to apply only to items which are material. We have to be very, very clear about it. Trivial items, it is not the intent. Nowhere in my whole financial statements of the accounting standards applicability. My framework for the preparation and presentation of financial statements, again, this framework is mandatory for all the chartered accountants in practice. It is mandatory for all the members. It provides that the relevance of information is affected by its materiality. Information is material if its misstatement could influence the economic decisions of the users taken on the basis of the financial information. Materiality depends on the size and nature of the item or other, judged in a particular circumstances of the misstatement. We have been saying again and again that wherever you find that something is not defined, then in the accounting standards or the standards in auditing, you go back to this framework for the preparation and presentation of the financial statements. Ind AS, if there is for the Ind AS as well as the AS. Whatever you need to have certain guidance, you can have that from this framework. However, there's also SA 320, which says that the materiality in the planning and performing of an audit, which deals with the auditor's responsibility to apply the concept of materiality in planning and performing an audit of financial statement. So materiality concept is very important, which we talked in our previous slide also, that it materially affects the true and fair view. The material misstatements, right, are materially not prepared. So we have to emphasize, I am talking about to you as a reviewer. To the auditor, I would again say that they should conduct the audit as nearly possible to give the true and fair view. But there also, I would say, materiality concept is there in the accounting standards. But if it is even non-material, they should not ignore it. Try and do the best. But of course, if it is not material, it can still be not done that way. Also, Schedule 3 to the Companies Act and reporting under CARO are also applicable to items which are material in nature. So materiality again given for in the framework, in the standards on auditing 320, in Schedule 3, everywhere it is. So materiality is a very, very important concept while you finalize your reports for the quality review. Now, let us discuss certain key findings by the reviewers and then by the board, which were noticed by the reviewers during their review and again, which has come to the notice of the board. The key findings on the standards on auditing. So auditing, we're talking about the standards on auditing. So if we look out here, so reviewed, if I talk about percentage of the reviewed audit firms having observation standard wise. So if we see maximum, we see 18% of the reviewed audit firms had observations on the SQC1, highest. And then SA 505, external confirmation. SA 720, my other matters. The other matters which is there in the director's report, which were not taken care of. And of course, 220, 250, 300, 315, risk 530, 580, 610, using the work of other expert, 710, prior period, previous year items. So all those standards, this is the percentage of the reviews. If we talk about audit firm-wise breakup of the observation, where we say 0 to 9 partners in blue, 10 to 19 partners in red, and more than 20 partners. So if we see, analyze just like this. So where there are more than 20 partners, so we see that the observation which is more is in SA 315, SA 300, SA 220, which is percentage of my total reviews concerned. SA 580. If I talk about 0 to 9%, then you see SQC1, my SA 250. In fact, in majority, lesser partners, if we see the higher percentage of observation in most of the centers. It is not that where the number of partners are less, there would be higher non-compliance of the technical standards. It is not that way, but yes, there may be certain issues where there are 2 or 3 partners or 1 partner, or I would say sole proprietorship also. They also do audit of such a bigger concern. So in those cases, the reviews and other compliances could be less, because there would be no quality review done by another partner or another person, outside person. So the observations or the quality of audit could suffer out there a bit. So SQC1, if we see, yes, in the initial year when 2015-16 the audit started, so initially the comments were very high, and then it took time for the quality review board to establish that yes, members or the firms started accepting that quality review board impact is quite huge, and they started slowly that the review is done by the QRB also. So they starting giving the effect of improving their audit quality later on in the later years. So one of the observation in the SQC1 is not documenting its policies and procedures on each element of quality control that should be sufficiently comprehensive and suitably designed in relation to the firm size, nature, and complexity of the firm practice. So that is as per the para 8 of SQC1. As regarding, because SQC1 is in relation to my engagement performance, human resources, assignment of engagement teams. So various observations that was found in regarding to human resources was that not establishing policies and procedures designed to provide it with the reasonable assurance that it has sufficient personnel with capabilities, competence, and commitment to ethical principles necessary to perform its engagements in accordance with the professional standards and the regulatory and legal requirement. So, para 36 of the SQC1 talks about it, which the I would say audit firm under review, AFUR, they should take care of. They should take care of. Another observation which was found was that this AFUR was not properly implementing firm's policies and procedures related to the personal, professional education, continuing professional development, training, etc., for developing competence and capabilities of personnel. So, in-house, outside, continuous professional education training, that was not found in some of the audit firms. As regarding to assignment of the engagement teams, AFUR was not establishing procedures to assess its staff's capability and competence before accepting the engagement, before assigning the team to the engagement, sending just like that. So that was also observed, because that you have to document that too, as per the SQC para 45. As regarding engagement performance, the AFUR was not keeping current the processes of complying with the applicable engagement standards for maintaining consistency in the quality of engagement performance, as the checklist for with the technical standards were not updated. So checklists were old, they were not kept updated in the current period for which the audit was done. As regarding the engagement quality control review, this was found lacking in various audit firms, and this was found even in some peer reviews also out there, that the AFUR is not establishing policies and procedures requiring for the appropriate engagements and audit engagement quality control review that provides an objective evaluation of the significant judgments made by the engagement team and the conclusions reached in formulating the report and setting out criteria against which all other audits and reviews of the historical financial information and other assurance and related services engagement should be evaluated to determine whether an engagement quality control review should be performed or not. So whether it is required or not, so that procedure was not done. Or that firm was not establishing the policies and procedures, setting out the nature, the timing and extent of the engagement quality control review, the criteria for the eligibility of engagement quality reviewers, and the documentation required for an engagement quality control review, which is given under para 63 of the SQC1. So moving away from the SQC1, we have not given here all the observations, but some of the observations which we felt that should be known to all the technical reviewers. SA 220, which talks about the quality control for an audit of financial statements, it was found that certain AFURs, they were not ensuring that appropriate procedure regarding the acceptance and continuance of the client relationship and audit engagements have been followed, and determining that the conclusions reached in this regard are appropriate. Again, para 12 of the SA 220. Another FUR, which was it was found by the TR that they were not documenting that engagement quality control reviewer has performed an objective evaluation of its significant judgments made by the engagement team and the conclusion reached in formulating the auditor's report. As regarding the SA 250, that is consideration of laws and regulations in an audit of financial statements, it was observed that one of the AFUR was not obtaining sufficient appropriate audit evidence regarding compliance with the provisions of those laws and regulations generally recognized to have a direct effect on the determination of material amounts and disclosure in the financial statements. Now, talking about certain standards, which is the risk assessment and response to risk, SA 300 series, 300, 315, 320, 330, 402, and 405, 450. Again, in 2015-16, quite huge. It came down, and then in 1920, a bit higher, but in 21-22, again a bit lower. These are the number of observations. It also depends upon the number of reviews done. In certain years, due to certain reasons, the reviews were less also. Initially, because there was a huge jump, so initially the reviews were higher. So that's why these number may not be reflecting the year-wise properly, but yes, they are important. And overall, when we saw the percentages give a correct view out thereof. SA 300, which is related to planning and audit of financial statements, it was observed that audit plan did not cover the nature, timing, and extent of direction and supervision of the engagement team members and the review of their work in respect of watching in the audit engagements. As regarding 315, an important standard which is in relation to identifying and assessing the risk of material misstatement through understanding the entity and its environment. It was observed that one of the FUR was not considering whether information obtained from the auditor's client acceptance or continuous process is relevant to identify the risk of material misstatement. SA 505, external confirmations that the FUR was not obtaining confirmation in respect to the related party balances or not maintaining control over the external confirmation request, including not designing the confirmation request, including determining that requests were properly addressed and contain return information or responses to be sent directly to the auditor. So these observations were noted that in relation to SA 505, these were not being followed. So number of observations or audit evidence, again, this chart reflects the same. As regarding SA 505, another that the AFUR was neither circularizing requests for confirmation of vendor and customer balances, as the management refused to allow auditor to seek confirmation request, nor documenting the reasons for management's refusal, as well as not evaluating the implications of management's refusal on the auditor's assessment of the relevant risk of material misstatement, and not performing alternate audit procedures designed to obtain relevant and reliable audit for evidence. This is given in the para 8 of the standard SA 505. Not determining the means of selecting items or testing what that are effective in meeting the purpose of audit procedure when designing test of control and test of details. So this is also not found that they had determined this. This is given in para 10 of the SA 505. Now, when an auditor informs a company, an entity that they have to comply with SA 505 and certain confirmation requests are made, and the percentage of the refusal or the percentage of non-confirmation is there, then the auditor is required to perform the alternate audit procedures, which is given in para 8. So one has to ensure that and document that, okay, we did that. As regarding SA 530, the audit sampling, it was observed that the firm was not considering the purpose of audit procedure and the characteristic of the population from which the sample will be drawn while designing the audit sample. So sampling, how it is done, random sampling or scientific, or what is the mode, how it will be drawn, what is the procedure characteristics, that was not done by this FUR. As regarding the SA 580, which talks about the written representations, the FUR was not obtaining the management representation for creating deferred tax on capital assets with the intention to sell the land. The deferred tax was created based on the assumptions and intentions of the management that will have gain on sale of mutual funds in future, which will be taxable against such deferred tax will be absorbed. So again, such observation was noted by the TR and the board. Another observation which was noted in the SA 580 was in relation to the written representation for the management was dated after the date of auditor's report on the financial statement, which says that how without the representation, how the financial statements were uh, audited by the management, audited by the auditor. This backdating thing, one has to be very, very careful. Now, after the audit trail, whether the auditor has, because this year it is not so, but again, next year when the audit would be done, the auditor will have to see that when they say that the financial statements are in agreement with the books of accounts, so on that date, there after that date, maybe it is whatever it is, starting of April, May, June, or even September, the changes to the or edits to the financial statement should not be there beyond that. So that, of course, one auditor cannot see beyond that, but at least on the date on which he is performing his issuing his audit report, he has to ensure that on that date the figures are final and not beyond that. So this noting which was done by the TR reflects that the representation was taken on a later date. As regarding the SAS 600 series, 600, 610, 620, regarding the using work of others, the number of observations year-wise, it is given in this graph out here, starting from 9 to remaining 2, 21, 22. So the two observations on this is SA 610, the using the work of internal auditors. The FAUR was not documenting conclusions regarding the evaluation of the adequacy of the work of the internal auditors and the audit procedures performed by the external auditor on that work in accordance with the paragraph 11 when the external auditor uses specific work of the internal auditors. And as regarding SA 620, this particular FAUR was not evaluating whether the actuary has the necessary competence, capabilities, and objectivity of the auditor's purpose for not evaluating the relevance and reasonableness of the assumptions and method used by him. So he has to document that. Now, as regarding the audit conclusions and reporting, SA 700 series, 700, 705, 706, 710, 720, certain observations which was noted again, a huge number initially years 2015-16, which came down slowly and gradually with the improvement in the audit quality and the improvement in the review system of the QRB and the technical reviewers. SA 700, the forming an opinion reporting on the financial statements. It was observed that in the audit report, a full para which was as given in the illustration to the SA 700 that was missing in the standalone financial statements. As regarding 710, the comparative figures, comparative information, corresponding figures and comparative financial statements in relation to the audit, this FAUR was not sitting in the other matter paragraph in the auditor's report in a case where the financial statements of the period were audited by predecessor auditor and the auditor is permitted by law or regulation to refer to the predecessor auditor's report on the corresponding figures and decide to do so. That the financial statements of the prior period were audited by the predecessor auditor, the type of opinion expressed by the predecessor auditor, and if the opinion was modified, the reasons therefore, and the date of that report of the previous audit. So that is required by SA 710, para 13. As regarding SA 720, in relation to the other information, the responsibility of the auditor, it was found that this FAUR was not including in the auditor's report a separate section with adding other information when at the date of the auditor's report for an audit of financial statements of an unlisted corporate entity, the auditor has obtained some or all of the other information. Now, again here, it would depend on case to case. It would depend upon case to case, and we have to read the implementation guide issued by the AASB of the ICI SA 720, which was done, I suppose, 2 years back. So please go into that and see that how, in this case, the reporting is to be done by the auditors. So for most of the standards on auditing and Ind AS and accounting standards, you'll find the material, the education material or the technical guide issued by the ASB and the AASB, which you can always refer to. So that was all regarding the standards on auditing, the key findings. Let us discuss some of the key findings of the accounting standards which were observed by the QRB. So if I talk about the overall percentage of the entities having observation on accounting standards, so AS1, AS9, AS11, AS15, 21, I suppose these are percentage of entities, 4%. I doubt these are number of the observations, I would say. And the percentage of entities having observation on Ind AS. These are AS, these are the Ind AS, and this is about the reviews conducted by the QRB and not the overall of the whole country, please. So again, here, if I talk about Ind AS wise, mostly if you see the higher number of observation was there on the Ind AS 7 and Ind AS 24. And then, of course, 1, 12, 37, 108, and 110, the second, and all other, the rest, all standards which we are discussing in this coming slides. So here, the type of audit firms break-wise, here 0 to 9 partners, most of them here, and 10 to 19 and 20 and above, not many observations found for the Ind AS compliance. So here, if I talk about 20 or more, certain observations found in case of Ind AS 1, Ind AS 12, 27 and 40, you see 20 or more partners firm also, and 0 to 9 partners, you see most of them, right? AS1, if I talk about, because the number of reviews are less of the accounting standards. Initially, prior to implementation of the Ind AS, applicability of Ind AS, majority was AS, hence we find this number huge. But slowly and gradually, when it shifted to NAFRA, I suppose it was in 2019-20 somewhere. So the numbers of the AS reports came less. So disclosure of accounting policies, it was noted that the accounting policies in relation to the accounting standard on leases, impairment, long AS 13 investments, basis of preparation, use of estimates, they were all not given in the significant accounting policies. Even though not mentioned here, but we have seen that in case of borrowings also it is not seen. AS9 revenue recognition, it was observed that the FAR was adopting accounting policy for recognizing revenue without transfer of significant risk and rewards of ownership to the buyer, not being in line with the requirement of AS9. As regarding AS11, the effects of changes in foreign exchange rates, this entity, the AFUR, observed that they were charging the entire, the TR observed that though the entity was doing something different, AFUR did not report on the charging of the entire amount of premium discount charges arising at the inception of the forward exchange contract to the statement of PL instead of amortizing it over the period of contract, which is a requirement as per AS11 as per the accrual system of accounting. As regarding AS15, this entity was not disclosing the information as required by para 119 and 120 for the defined benefit plan in the financial statements. As regarding AS21, the consolidated financial statements not disclosing the information required by para 29 of the CFS. Now, these all were noted as related to the AS15 and AS21. And the accounting standards. As regarding my Indian accounting standards, Ind AS, certain observations and relief which were observed by the QRB, done by the TR and then by the QRB. The non-current assets held for sale and discontinued operation, that is Ind AS 105. It was observed that the entity was not making following disclosures for the non-current assets classified as held for sale: a description of the non-current assets or disposal group, a description of the facts and circumstances of the sale or leading to expected disposal and the expected manner timing of the disposal, the CDE, other operating segments and others. Now here, that company was not disclosing, which was required as per Ind AS 105. So in this case, neither the company disclosed nor the auditor in his report mentioned that the Ind AS was not properly complied with. So here the auditor role could have been appropriate if he had mentioned that in the auditor report that the entity has not disclosed the same. So it is for not only this Ind AS, it is for all the AS and Ind AS. Ind AS 107, financial instruments, the disclosures. This entity was not making category-wise classification of certain classes of financial liabilities by classifying them as measured at fair value through profit or loss or measured at the amortized cost. And another entity was not disclosing items of income, expenses, gains or losses either in the statement of profit loss or in the notes to the financial statement by classifying them as financial assets, financial liabilities measured at the amortized cost, the FVOCI or FVTPL. Right. Again, this entity was not disclosing the fair value of the financial assets and the financial liabilities along with the comparison with the carrying amounts, not disclosing the maturity analysis of its non-derivative financial liabilities, not disclosing sensitivity analysis of for each type of market risk to which the company is exposed, such as currency risk, interest rate risk, and other price risks. So this is given in para relative to 25, 39, and 40 of the Ind AS. As regarding the operating segments, Ind AS 108, the corresponding AS is AS 17 under the company's accounting standard rules 2021. Now, this entity was not making disclosure in respect of segment reporting as required by the Ind AS 108, nor has disclosed the accounting policy of the operating segments in the summary of significant accounting policies. Another observation was that it was not disclosing the factors used to determine the company's reportable segments, including the basis of organization in relation to the disclosure provided by the company and judgment made by the management in applying the aggregation criteria. As regarding the consolidated financial statement in Ind AS 110, it was noted that the balance handle bank in one of the subsidiary companies was added with the cash in hand while preparing the consolidated financial statement. It seems to be clerical error out there. Another was noted was that not disclosing other comprehensive income OCI for the year attributable to the owners of the company and non-controlling interest on the face of the statement of PL in CFS. Ind AS 113, the fair value measurement, they were not disclosing the valuation techniques and inputs required for this financial assets and financial liabilities. They are measured at fair value. And regarding Ind AS 115, revenue from the contracts and customers, another very important Ind AS, that was not disclosing the revenue recognized during the year out of opening contract liability, not disclosing of obligations for the return, refunds, and other similar obligations and type of warranties and other obligations, not preparing and disclosing a reconciliation between the amount of revenue recognized in the statement of PL with the contracted price, showing the separately each of the adjustment made to the contracted price on account of discounts, rebate, refunds, exchange rates, and fluctuations, etc. Ind AS 1 again, another observation was that in relation to the presentation of the financial statement, that it was not disclosing the policy for cash and cash equivalents in the summary of its SAP. Also, it was not disclosing the company's objective policies and processes for the managing capital. Statement of cash flows, Ind AS 7, the whole list here, if you see one of the majority item in Ind AS 7 where a lot of observations were noted by the TRs that the increased decrease in investment has been shown as cash flow from financing activities instead of cash flow from investing activities. So one has to determine whether it is financing activity or my investment activities or my operating activities. So some differences could be there, and you have to report accordingly. That decrease in borrowings has been shown without taking into effect the adjustment with the current maturities of the long-term debts, or the WDB of the PPE was shown as proceeds from sale of assets instead of actual cash proceeds received under cash flow in the investment activities. So these type of all uh, observations were noted, like not disclosing the amount of significant cash and cash equivalent balances held by the entity that are not available for use. That is also a requirement for the cash flow statement. So all these, it is there. This PPT would be, of course, shared by Mohitji with all of you. So you can just go through that later on also. So another Ind AS where the observation was made by the TR was not disclosing the date when the financial statements were approved for the issue and who gave that approval. Or income taxes Ind AS 12, that not measuring the deferred taxes and liabilities at the tax rates that are expected to apply to the period when the asset is realized or the liability is settled based on the tax rates and that have been enacted or substantively enacted by the end of the reporting period, as wrong rate of cess was applied for calculating the deferred tax and wrong rate of depreciation on computers as per the income tax report was used for calculating the deferred tax asset and liability. Or it was not measuring the deferred tax assets created in earlier years at the tax rates that were expected to apply to the period when the asset is realized based on the tax rates that have been enacted by the end of the reporting period, or not reviewing the carrying amount of the deferred tax asset at the end of the reporting period and not reducing the carrying amount of the deferred tax asset to the extent that it was no longer probable that sufficient taxable profit will be available to allow the benefit or part of all of that deferred tax asset to be utilized. Then again, in leases, it is there, not disclosing the policy relating to perpetual lease, employee benefit Ind AS 19, not providing the description of the risk, not disclosing the description for any funding arrangements to affect the future contributions, and in relation to the related party disclosures, Ind AS 24, not disclosing the KMPs, the compensation for each category, short-term, post-employment benefits and all this, not disclosing the nature of relationship with one of the related party for the shares held by it in the company, disclosing incorrect amount for trade receivables and the disclosures for the related party transactions, not disclosing the related party transactions were made on the terms equivalent to those that prevail in the arm's length price. Separate financial statements, not disclosing Ind AS 27, not disclosing in the accounting policy that investments in associates and joint ventures were valued at cost. Ind AS 37, provisions, contingent liabilities and contingent assets, not disclosing for certain class of contingent liability at the end of the reporting period, a brief description of the nature of the contingent liability, not disclosing the estimate of the financial effect on money uncertainties, and investment property Ind AS 40, not disclosing the criteria used to distinguish investment property from the owner-occupied property and from property held for sale in the ordinary course of business. So these were certain observations in the Ind AS. Now we have got just a few minutes left. So just sharing with you the key findings on the other relevant laws and regulations. When we talk about it, it is either at that time up to last year it was Caro 2016, Schedule 3 and certain others. So Schedule 3 majority you will see, and Caro of course you will see some more. So type of audit firms, you see 10 to 19 partners. This is partner wise, the firm partner wise summary is made out here. If we talk about Schedule 3 Division 1, that is non-Ind AS, not using the correct nomenclature, PPE, they must be using figure sets, or not using the correct nomenclature for further bifurcating the trade payables into due to micro, MSMED and others, not disclosing the terms of repayment for long-term loans in the financial statements. You know, these type of errors could be there, the nomenclature and others. So these, I would say, as discussed at the beginning of this session, that these are actually not material. These are not impacting the true and fair view. So while giving your comments thereon, while issuing your report, please place it appropriately. It is not that when you have done a review, you have to mention the things which are not material also. To an extent you should mention, but not each and every. You have to take care. Okay, tell them to take care of that, and though make a part of the report, but in the non-material portion. Not disclosing in respect of non-current investment, then the notes, the aggregate amount, and the thing that which is required as per my AS 11. Division 2, not disclosing separately net gain or loss on foreign currency transactions in the financial statement, not disclosing breakup of various heads of expenses, including the CSR expenditure. If I talk about Division 2, general instructions wise, heading used in the notes to the financial statement was different than one used in the balance sheet. Not cross-referencing for the tax expense appearing on the face of the statement PL, stating EPS in rupees without mentioning that it was in rupees. While all the figures are reported in crores, but some figures were reported in absolute amounts. Not providing corresponding amounts comparative for the immediately preceding reporting period and respect of ownership interest in the case of joint ventures. Balance sheet, if I talk about, that was general instruction, then the non-current assets, non-nomenclature, PPE, not using that. Disclose deferred tax asset instead of deferred tax asset net. Current assets use the terminology work in progress instead of work in progress, as further as classification of inventories under the current assets in the balance sheet. Smaller errors, but these again, in my view, though it has come to the board and we are sharing with you, but these should, in my view, not come as your in your report. These items. Certain items, not all, but of course, these clerical errors should not classifying the items such as capital reserve and retained earnings under the head reserve surplus in the statement of changes in equity, not showing each reserve under the other reserves. Current liabilities, again, not showing employee benefit obligations under the provisions under the non-current liabilities, not disclosing the repayment terms such as amount of installment due, not disclosing the interest rate applicable on all long-term as well as short-term borrowings. As regarding current liabilities, not showing on the face of balance sheet the outstanding dues to MSMED. Current year provision for income tax has been netted off with the refund income tax receivable for the earlier years. Statement of PL not representing revenues from operations as net of GST in the statement of PL. Use the term profit on sale of fixed assets instead of using profit on PPE. So fixed asset PPE still it is going on. Not disclosing separately dividend income in the profit on sale of investment under other income in the statement of PL. Making charges charged from customers as part of revenue from the operations was shown as deduction from direct expenses instead of showing them separately as revenue from operations. So grossing up or netting off, that issue is there. Using nomenclature operational and other expenses instead of other expenses. Netting of FCNR loan interest paid to bank with the interest received on FCNR loan. So netting is generally not allowed, or not providing to them in the notes to account related to CSR expenditure the details required, not disclosing the amount of expenditure incurred on CSR activities. So that is there. Caro, if I talk about not carrying out sufficient necessary audit procedures to comment upon the figures were physically verified at reasonable interest or not. So this comment was there. When auditor was not present when verification of figures was made, then not examining the instructions issued to the staff by the management. This is all required in the guidance note. Report on whether the title is the freehold land and buildings were held in the name instead of for all immovable property. It was required as per the CARO requirement. Not disclosing the name of the statute period to which the amount relate, due date and date of payment for the undisputed statutory dues. Use the term generally regular when it is asking only whether it is regular or not. Not mentioning complete name of the statutes while reporting, so abbreviations, etc., not allowed. Not reporting the fact of deposit of undisputed dues having made under protest in this report. Not disclosing the period to which the amounts are related. While reporting on the dues not deposited, not reducing the amount already paid by reporting the dues of duty to the excise, reporting wrong forums where disputes are pending. So all these were noted. So these were various observations which were noted by the observers, and which came to the board. And we thought that when you are doing the reviews, you should take care of all the compliance of the technical standards. I hope that when you do your reviews, you take care of the amended definition in the procedure for the non-compliance, and ensure that whatever is material that is brought in your report appropriately before the board. Thank you very much.
Thank you, sir. Thank you so much, sir, for your presentation. Such an exhaustive and a very comprehensive presentation on covering all the aspects of technical standards within a span of just 1 hour. We have been able to cover all the key findings which have been observed by the QRB in the financial year 21-22 with regard to all these areas of SAs, AS, other relevant laws and regulations covering CARO, Schedule 3, primarily, and the certain other areas. Apart from briefing them about how they are required, the technical reviewers are required to present their report when they give their report now on in terms of the revised procedure, how it would be, it would benefit the board when we consider the report in terms of the revised procedure and the revised requirements. Because in the previous presentation also, the Anivasar also shared with them the entire process which they are required to follow. Apart from the focus areas, we have also now required them to give a separate report on certain focused areas covering 8-9 specific areas like auditor independence, SQC policies, reporting on related party transactions, and such other areas, important accounting estimates, and all such areas where he elaborated on all those areas. So now I think I hope reviewers would have been tremendously benefited, though in a span of 2 hours we may not be able to cover all such all the aspects. But I think in the times to come, I think we will continue to conduct such type of more such interactions with the reviewers and try to cover more such areas. So there are a few questions, though we are running out of time. I will not take all of them, but at least a few of the questions I'll take up. The rest of the questions, I think I'll respond to the concerned reviewers separately. So one question is, when a non-compliance is that of, say, non-disclosure of a significant accounting policy, then there is no materiality quantification. In such a case, what is to be done?
If we talk about, you have to first ascertain, okay, what is that accounting policy and is that material in that financial statement? Now, for example, you say there is a material foreign transactions and foreign currency transactions, and the foreign currency reporting accounting policy has not been given. So in that case, what is that when you report in your auditor, when the auditor reports in the auditor's report, he should have mentioned that the accounting standard on the foreign exchange fluctuation has not been properly followed, the disclosure has not been given. If that is not given, then of course that is required. That is required.
There is one question. The present questionnaire for QRs is very lengthy, drafted in such a manner that entire, even very minor details of SQC, India, SA, etc. are covered, and there are many repeated or overlapping questions need to relook to make it comprehensive. If there are any overlapping areas, we can definitely look at that and try to address those areas.
Kindly give your suggestions that, okay, this is overlapping, this is again. Surely the board would look into that and make the necessary changes if required appropriately.
The observations of technical standards have come down drastically in the recent years due to shifting of reviews by NFRA.
It is not that way, I would say, because it is not that only the observations are there on the technical standards of the listed entities. Only that because at the time of shifting, there was certain time lag to select the new reviews. So that affected into few lower reviews. But thereafter, again, the volume of the reviews has increased. So now we are looking into various reviews which have been various, I would say, cases where the reviewers are being given the audit file to be reviewed. So now it is streamlined since last 2-3 years.
In case of a proprietorship firm or firm having only 2 partners, whether it is compulsory to have financials reviewed from independent firm or CA?
A very important point out here, it would depend upon what is the complexity or what is the, I would say, category of the audit done of a company, or even not a company. Because here this SQC1 and SA220, they both are mandatory. So in case of a smaller audits, SMP audits, or level 2, 3, 4 in the proprietorship, and of course I will not say SMC, I would say small company. A small company in a company, the review can be, you can say that in case of proprietorship and having 2 partners, the other partner of course can review. In the case of proprietorship, the review can be done by an outside chartered accountant out there. They can do it. But in the case of, again, the bigger companies, or I would say not a small company, or level 3, 4 entities other than companies, please see that this is complied with. Moji, you want to add something to this?
No, sir, you have adequately covered that. There are a few other questions also, I think, but they are more specific to some specific cases only, not in general terms. So we'll respond to them separately. Thank you, sir. Thank you so much for joining with us today. We'll keep bothering you again and again. I think we'll organize some more programs where we will keep engaging.
So nice of you. Thank you. Thank you very much, Moji. Thanks to all. Thank you.
Thank you all our reviewers for joining. Thank you.